Good day. In this lecture, we are going to talk about financial portfolio optimization. We'll try to understand what is financial portfolio optimization. Well, portfolio optimization is the process of selecting the best portfolio, the best asset distribution in simple words, out of a set of all portfolios being considered according to some objectives. What are the typical objectives that are interesting for investors? Investors typically they want to maximize expected return and they want to minimize costs. So portfolio optimization is the process of selecting the best portfolio out of a set of all portfolio being considered according to some objectives. As I said, the objectives are typically to maximize expected return, minimize the cost of financial risk. And the factors that are considered may range from tangible factors, like for instance, assets, liabilities, earnings, or other fundamentals, but also to intangible, like for instance, selective disinvestment. So portfolio optimization should result in what investors call efficient portfolio. And this means it's generating the highest possible return at your established risk tolerance. The efficient portfolio generates the highest possible return given a certain risk. This is also known as optimal asset allocation, and we will discuss more in details about this when we are going to talk about modern portfolio theory. What is the modern portfolio theory? It is a theory which has been introduced in 1952 by Harry Markowitz. The idea behind modern portfolio theory is that an investor wants to maximize portfolio expected return given a certain amount of risk he wants to take. So there is a trade-off between expected return on one hand and risk on the other hand. So the risk-expected return relationship of efficient portfolio is graphically represented by a curve known as efficient frontier. All efficient portfolios, each represented by a point on the efficient frontier, are well diversified. So in the graph on the right, you can see the expected return, risk, and you can see the efficient frontier. Where the efficient frontier is tangent with the capital market line, we have the portfolio, the market portfolio. Let's spend a couple of words about risk. Risk is the possibility of losing something of value, but also is the possibility of gaining. So risk is the chance that you will lose money on an investment and you won't see the return that you expect. However, investors also measure risk through volatility, which refers to the likelihood an asset price will change significantly. So risk is something that is not necessarily negative. I mean, if I have a security in my hands and the value of the security is 100 today, tomorrow it could be 99 or 98. In this case, I incur losses, but it could also be 101, 102. And in this case, I generate a profit. So from risk, we can have losses, but we can also have profits. Risk is a word which comes from French, and it's defined as the exposure to possibility of loss, injury, or another adverse or unwelcome circumstance. It is a chance or situation involving such a possibility. So let's introduce now the concept of diversification. Well, diversification is the process through which an investor prefers to invest in a wide variety of asset types and classes in order to reduce risk. So a diversification across asset classes is the risk mitigation strategy. And financial asset classes include different types of securities, but also debt and equities. So typically, diversification can occur through bonds, through income-generating bonds, through stocks, commodities, contracts, and also cash and equivalents. So let me spend a couple of words about those types of securities. Well, bonds are debt instruments issued typically by governments and large companies, but nowadays more and more small companies are also issuing bonds in order to raise funds directly in the financial market. Income generating bonds is a subset of bonds and pay interest on a regular basis. Then we can have stocks. Stocks are shares of ownership issued by private companies, which typically break out into large, mid, and small cap categories according to the size of the issuing firms. So stocks can be issued typically by small companies, by large companies, by medium-sized companies. Large companies are typically listed in the stock exchange. So we have quotations on stock prices, and they can be easily bought and sold in the stock market, whereas small companies are typically liquid, and therefore it's not very easy to buy or sell shares of small companies. Then we can have commodities, ownership of goods and products, typically raw resources, which trade based on their future price. So we know that investors can decide to trade on commodities. They want to buy, let's say, gold, orange juice, oil, and they can trade in order to buy them at a lower price and sell them at the highest price. We can also have contracts, which are instruments issued by private parties, like for instance, certificates of deposit and annuities. And last, we can have a cash and equivalents, which are money in a bank account or other secure asset that you can liquidate immediately. What are the most relevant strategies for portfolio optimization? Well, the asset allocation is based on two relevant steps. First of all, we have to select the asset classes, and then we have to select assets within classes. So what portfolio managers typically do? First of all, they choose the asset classes they want to invest in, and then they decide the weight of every asset class to be included. So they decide, for instance, that they want to invest 60% in bonds, 40% in stocks, let's say. And then once you decide the proportion of different asset classes, then managers decide how much of a particular stock or of a particular bond does she wants to include in the portfolio. In this graph, we have the strategies for portfolio optimization. We have an example of efficient frontier where we have a frontier where the green line is represent the frontier.